Let me now bring on board Sean Darby, Head of Equity Research with the Jefferies, who joins us live from Hong Kong. Sean, this question is coming your way. What do you make of the Greek debt deal, and for a equity market, and from an equity market perspective, how important is that?
Well, we've had three real big policy uncertainties going into 2013. You've got the EU budget, you've had the US fiscal cliff, and also, of course, as you just mentioned, the negotiations over Greece. I think our bottom line really is that ultimately Greece will need to do a widespread debt restructuring, and that probably means some form of soft default towards some of the European government bodies. And really, this is just a postponement of that going into the elections in Germany early next year. So I think the equity markets and risk markets really have got still to look towards some point in 2013, late 2013, to some form of measures to either allow Greece to leave or to do a much more wider spread debt default, because the dynamics for Greece really mean that they can't repay this debt despite the austerity measures that have been ongoing for the last 12 to 15 months.
Sean, if I look at the broader tone of global economy, are you pleasantly surprised that global growth is making a comeback? US economic data has been strong, the Chinese PMI data has improved, and if I look at the news flow which is coming from Europe, one is getting a sense that growth is making a comeback.
Well, I think I wouldn't want to say there's too many green shoots out there just yet. I think you just have to put into perspective that most of Europe it will actually be in some form of recession early next year, and Japan is probably already there. The US is going to be tentatively going into some form of quite sharp slowdown early next year because we don't think the fiscal cliff will be dealt with. So I think what you're seeing at the moment is partly a seasonal bounce because of shipments of orders for Christmas. And secondly, I just highlight that actually inventory levels in the corporate sector has kept production levels pretty much in line with inventory, and therefore I don't think you're getting the big overhang that you saw in 2008. So the bottom line really is that there's little downside to some of the production data at the moment because inventories are so thin, but be a bit careful because early next year you will get some form of fiscal tightening in the US, and that's going to curb growth even further.
Sean, if I look at the broader environment, most of the major asset classes after the announcement of QE3, they have retreated. Do you think the QE3 trade has failed and easy monetary policy is no longer supportive asset prices?
No, not really. I think you have to look at it in a broader context. I think the part of the reason for the introduction of QE infinite or QE3 really was to offset the contraction that's going to go on in the US as revenues are curtailed and also as taxes are raised, and that's going to have a noticeable effect on US liquidity conditions. The second thing to bear in mind is that the US Federal Reserve cannot lower rates. It's hit by this lower band now, and therefore it has to adopt very unorthodox policy to allow that to actually flow into the real economy. I think with the effect on asset prices, I think it's been mixed, really. I think we're still seeing a very, very huge demand for income, and that's been noticeable in flows into global equity and products that are related to income and, of course, into government bonds. So I think the jury has to be out on QE because certainly if the authorities in the US hadn't done any form of monetary loosening over the last 2.5 years, I think the US economy would have been mired in a very, very big deflationary environment.
What are your thoughts on India? For this current calendar year, Indian markets have appreciated by about 20% plus. Do you think for next year, which is 2013, we could be staring at similar gains?
Well, I think part of the reasons that Indian equities have looked favourable for foreign investors is because of the very strong domestic growth of the equity market. And if India falls alongside those in the Philippines, Malaysia, in that camp, people have liked the story where you have relative immunity to the export cycle and to the problems in Eurozone. So from a foreigner's point of view, that's really been the case for those ASEAN and Indian equity markets. I think for next year, the irony may be is that if we do start to get resolutions in Europe and in the US and some sort of horizon of investment where the authorities start to tackle the fiscal issues, and that allows these companies in US and Europe to start to spend again on capex, I think that the story may swing the other way. And I think bear in mind that the corporate sector in Europe and the US has got enormous amounts of cash on their balance sheets and really are need to be incentivized to spend it, and that would have a very noticeable effect on the multipliers for the developed world. So I'm a little bit more optimistic that once we see through the problems in the fiscal issues in Europe and the US, that the corporate sector probably leads the way a lot more than it did in the last 18 months, and that might favor developed markets over India in the second half of 2013.
Sean, nonetheless, in the near term, sticking with India, some investors have been pretty enthused about the recent reforms announced in India. What do you make of these, and are they enough to revive growth for the country at this point?
Well, there's been an enormous amount of optimism towards the reform measures, and they probably came at the right time for India, given the debates that's been going on about long-term growth. I still would say that if you're going to get structurally sound growth for India, you're going to have to do it on balancing both the fiscal needs and also the fact that you need to put in an enormous amounts of electricity generating production. And I think whilst domestic stories do look quite good, ultimately you've still got to be able to produce electricity power. And I think the theme for India, which I think I'm quite happy about given the reform measures, is towards the electricity and generating sector, because without that you'll still be on sub 6% growth, and none of the other stories in India can really unfold without that being in place.
So what is your current house view on India? Are you neutral on India? Are you underweight on India? Are you recommending your clients to go overweight on India?
Well, I've been a little bit more, how should I say, sanguine about the prospects in India, but I'm hesitant to make too bigger dramatic overweights on the market, mainly because you have issues on the current account and fiscal position, which I think ultimately the markets will test, and they're going to test it not only perhaps through looking in what we've seen in Europe over the last 18 months, but there are countries where these levels of current account and fiscal positions, like in Turkey, for example, I think will ultimately get tested again by the financial markets, and that probably means that one has to be cognizant that some of the good news has already got priced in the equity market in India.